Hi, class, and welcome back. Welcome to Chapter 11. We will be discussing liabilities. More specifically, we'll be discussing bonds payable. Uh, as a quick housekeeping note, I just want to assure all of you that I am actively in the classroom every day, as you noticed. And as I am in the classroom, I am continually updating the grade book and looking at everyone's performance. For those of you who are missing work or have fallen behind for whatever reason, or I feel that you may need some additional assistance through improving your overall grades, I've reached out to you via email. I will continue to do that because it's important that since you're staying on top of the work, that I'm also helping to assist you in that process. Because my goal is to ensure that all of you pass this course and that you gain the necessary knowledge of accounting to be successful in your objective of moving into management, opening your own business, whatever your objective is. I want to make sure that you're successful in that endeavor. So my goal is to help you along the way. So by doing so, I try to be in constant contact with all of you. For those of you who I may not have reached out to, it probably means you're doing well, right? So kudos to you. So just real housekeeping note, we got like 2 weeks left of the semester. That's not a lot of time, yeah? So what does that mean? The final exam's coming up in 2 weeks. We have, I believe, about 4 assignments remaining. So please feel free to work ahead if you see fit. That will only help you in the process. Yeah. So and again, if you ever need help or if you ever have questions, just reach out to me. Send me an email, call me, set up office hours with me. I'm here for you. That's my objective, is to help you in any way that I can. For those of you who are going to be joining me for Accounting 202, which is starting next month, or end of this month, I guess, welcome. For those of you who are going to not continue on with me for the rest of this semester, but might join me next semester, I strongly encourage you to please join me on LinkedIn. If you have an account with LinkedIn, please find me on there. I'd love to stay connected with you because, as I said before, I look at my students as mentees, and I want to continue to mentor you throughout the rest of your program and beyond. And I like to stay in touch with you because I always love to know how my students are doing, even beyond school. And if there's any way that I can help you, please let me know. As you know, I have a lot of connections in the industry. I have a lot of opportunity for my students as well. So please reach out as you see fit. So okay, let's move on to Chapter 11, liabilities and bonds payable. Well, it's more just bonds payable. Yeah. So what is a bond? A bond is a loan. It's an interest-bearing loan that is similar to a loan that you would get from a bank. A bond is a specific type of loan that can be made by individuals or banks, and that loan is made to the corporation, the business, the corporation. These loans they're interest bearing. They have a face amount, which is the principal balance, and they need to be repaid at the maturity date, which is also known as the due date, right? Creditors of the corporation are called bondholders, and they have claims to the corporation's assets ahead of the stockholders. What does that mean? So in the event of bankruptcy or the business goes out of business for whatever reason, the first people to get paid back are bondholders. They have the first claim to the assets, and they can be repaid through those assets before stockholders get repaid. Okay, so let's talk a little bit more about the terminology and what do bonds look like. So bonds issue normally, a bond issue is normally a divided into a number of individual bonds. So what does that mean? Let's say a company has a $100,000 bond. That $100,000 is typically made up of a number of small individual bonds. And there might be 100,000 different bonds that equal that $100,000. So there's, in other words, a bunch of small bonds add up to a larger bond. That's the idea behind bond issuance. Bond issuance. The face value of a bond is called the principal balance, just like a standard loan would be. The principal balance is the face amount, the face value. And in bonds, they're usually in increments of 1,000 or multiples of 1,000. Basically, a minimum is $1,000, and a bond is in increments of 100,000. The principal, of course, must be repaid at the bond's maturity date. Maturity date. The maturity date is when the bond is due. The interest on bonds is typically paid annually, semi-annually, or quarterly, depending on the bond indenture. Most bonds typically pay semi-annual for interest payments. The underlying contract, this is the agreement between the bondholder and the corporation. This is that contract we talked about, yeah? It's called a bond indenture. Fritz, did you have a question, comment?
Yeah, is that the one they list? Because I noticed I have a couple of bonds, and they're saying that I won't get no return until after 90 days. So is that what you're talking about?
That's
'Cause-
correct. Yep,
okay.
yep. So if you hold a bond with a corporation, that bond will pay its interest quarterly, semi-annual, or annual. So 90 days, you're looking at a quarterly payment. So and this is common, and it all depends on when the bond indenture says it's supposed to be repaid. So as a bond holder, you'll receive interest payments on a quarterly or semi-annual basis. And at the maturity date of the bond, you'll receive the face value. So yeah, that's exactly right. Good question. Okay, so let's talk about some characteristics of a bond and the different types of bond. There are two common types of bonds. One is called a term bond. That means that it matures at a certain time. Or I should say, a term bond is when all of the bonds collectively mature at the same time. So as I said earlier, one bond can be made up of several small bonds, okay? And all of those small bonds can mature at the same exact time. We call those term bonds. The other most common type of bond is called a serial bond. Serial bonds means that they mature at several different dates over time. So if you have 1,000 different bonds that make up one bond, those 1,000 different bonds might mature at different days throughout the calendar year. And so we call those serial bonds because they occur in serial or sequence. Think of the word, when you hear the word serial in accounting or finance, it means sequence. The word serial means sequence. They occur at different dates over time. There are also other more complicated bond structures. that we'll just talk about, but we won't be too terribly concerned about calculating them. One is called a convertible bond. A convertible bond means that the bond can be converted into common shares of stock, converted or exchanged. The bond can be converted into shares of common stock. That's called a convertible bond. We also have what's called a callable bond. This is a type of bond that can be redeemed by the corporation prior to its maturity date. It's called a callable bond. When you call something, you're redeeming it. When you call something, you're redeeming it. When you put something, you're returning it. And we'll talk more about calls and puts in the next chapter. We'll talk about stocks.
Yes, sir.
Yes.
With the callable bonds, is that like a way a corporation can create an account where people can just reinvest in bond after the bond matures? They can just rethrow it, like reinvest it
That's
back in.
right. Yeah, that's exactly what that is. So a callable bond is basically the corporation is saying, hey, listen, instead of me paying you back the interest and face value at the date of the maturity, I'll pay you back early, and the corporation will typically reinvest that fund into that account you were just talking about for it to be reallocated.
So I noticed Apple and Amazon has multiple different kind of bonds, and I saw that, but I didn't feel like that I wanted to invest that much money into something I didn't quite understand. When I tried to Google search that, it was giving me a whole bunch of different answers, and I just didn't feel confident.
Yeah, so callable bonds, they can be a good investment, and the reason being is because typically and it depends on the bond indenture, but typically when a corporation has a callable bond and they repurchase that bond before its maturity date, the company typically pays out more in terms of interest because of that call that's made before the maturity date. So it could be a good investment. It depends on the bond indenture. So if you read the bond indenture and it says they pay X amount more prior to the maturity date, it's probably a good investment from a personal perspective. Yep. So very good. Okay, let's talk a little bit more about the issuance of bonds and the proceeds. When a corporation issues the bonds, the proceeds received from the bond depends on the face value, which is the amount that's due at the maturity date, the interest rate on the bonds, and the market rate of the interest for similar bonds. Now, just to clarify, when you hear the word market rate of interest for similar bonds, the market rate is different than the actual interest rate, typically. What do I mean by that? On the open market or the open exchange, the NYSE, which is the New York Stock Exchange, the Chicago Stock Exchange, the NASDAQ, the Dow Industrials. Anytime you see market rate of interest, that's what the market tells us. Okay, so a way to think about it is your house, your mortgage. Your mortgage interest rate that is locked in is probably going to be different than the market rate for mortgages. The market rate for mortgages is something that's determined by the collective of mortgages, and it's an average. Okay? That's the market rate. So, like for example, like if I go to buy a house in a few months from now, I'm going to look at the market rate, which tells me what is the average for a 30-year mortgage? What is the average for a 15-year mortgage? Those averages that we call it the daily rate. That daily rate, that's the market rate, because the market is saying this is what the interest rate is right now. Okay? The interest rate on the actual bond itself is going to be different, because that's what I'm going to get locked in at. And that depends on a number of factors like credit score and things like that. But that's the difference. When you see interest rate and market rate, they're different. The interest rate for the bond itself and the market rate for bonds is going to be different. The interest rate for the bond itself might be higher or lower than the market rate. The market rate changes every day, and because it's based on an average of similar bonds. Okay, the face amount of the interest rate on the bonds are identified in the bond indenture. Again, the bond indenture is that contract between the bond holders and the corporation. The interest rate to be paid on the face amount is called the contract rate, also known as the coupon rate. That is the interest rate that's tied to that bond, contract rate. The market rate of interest, which what I was just talking about, is sometimes called the effective interest rate, and it is determined by the sale and purchase of similar bonds. It gives you that average. It's the average of similar bonds that are available on the market. The market rate of interest is affected by factors such as current and future economic conditions. That makes sense. So in other words, the market interest rate will change depending on economic conditions. During not so good economic conditions like what we're experiencing right now, the interest rates are lower. The reason why the interest rates are lower is because during difficult economic times, interest rates go down, because the idea is lower interest rates will encourage more market participation to eventually increase economic activity, which will ultimately improve market conditions. During times of good economic conditions, interest rates are typically higher.
Professor. Good.
Yes.
I can and I joined just a time. How you doing, Professor?
I'm good, Lakeisha. How are you?
I'm doing wonderful. Guess what? I'm getting ready to go and trade my car. And you're so right. I didn't know. I looked up. All they said October, November, December is the best time to trade your car, buy a car, or any of that nature.
Sure.
And that's because when I contacted the car dealer, they said, "Oh yeah, we got a whole bunch of discounts, rebates, everything on all their trucks." And I want me an SUV, so I'm getting ready to go trade my car in because I'm paying too much for my Corolla. Mr. Dr. B. I really am. I'm paying too much for this car, and I'm trying to get me a truck. So me and my son is getting ready to ride out to the car dealer in a few to go get so I can go do that. And when you said something about the interest rate, let me tell you, when I went and got my car, do you know my interest? Because I did not know, I was a new buyer. I did not know anything about buying cars. Do you know, Professor, that my interest rate was 22%?
Holy smokes.
Do you
Wowza.
hear me, Professor B? Do
Wow.
you understand how much money I done put into this car?
That's way too much. That's
Way too much, Professor B.
insanely
I
high.
said, you know what?
Well,
I'm so mad at Auto Johns. I'm so pissed with them. My
I would
credit
be
score when I
too.
went with them was
Yeah.
603. I
So,
said, because they got me with this rinky-dink finance company, it's messing with
yep,
my
that's what they
credit
do.
and everything. Man, Professor B, I said, I gotta get out this car. I said today, because I said what I did was made my last payment of what I owed last month. So my
Good.
car payment is coming up on the 11th. But
Gotcha.
I paid more than what I was supposed to. I said it doesn't matter. But I don't want to make this another payment. I want to get out this car. So that's what I'm
What?
going to do. Professor B, get out this car
So,
ASAP.
Lakeisha, one alternative you could do is you could refinance the car with your bank or with a local, credit union, and you could refinance it. And if you like the car, obviously. Um, otherwise you could do what you're saying. But what I would do in your situation,
Yeah, what would you do, Professor B? Like, what would you like? So, because
I
I
I would
really
first go to a bank
because
before I went
I
to
know
any
I got
dealer.
a lot of money. Yeah, I'm not really trying to put up, a lot of money because I was at least gonna put two on my car,
Right,
2,000
right.
starting. But I was like, I wasn't trying to put up, a
No,
lot
yeah.
because of the economic,
So,
what's going.
so what I would do in your situation, I would first talk to a banker.
Okay,
Okay, tell them the situation, tell them what you're looking to do, and then from that point, see if you could get like what they call it's basically a type of loan that's they call it pre help me out here. What am I trying to say?
oh, was
Pre-approved.
it pre? Is it pre? What is it like? You getting pre-approved? Pre-approved? Hold
Exactly.
on. So the Navy Federal is like that. So where they say
There
where
you
they
go.
give you
So
a certain amount, and I could just go and
that's what you
all
need
the
to
money
do.
that certain amount to pick out my vehicles.
That's what you need to do. Get
Okay.
pre-approved
Okay.
first through a specific bank
Okay.
before you go down to the car dealer.
Okay. Okay. So I'll tell her I'll reschedule today and tell her I need to just make a couple of calls and I'll just tell her I'll just let her know when I'll be out there. I'll text her and let
So
her know.
so that way you won't get in trouble with that interest rate again.
Okay. Okay. That'll work for me. Thank you. So I'm
My
so glad I got
pleasure.
just this time. Thank you so much.
Hey, anytime.
Okay.
Okay, so let's keep going. So by comparing the market and contrast rates, okay, in other words, by comparing the bond interest rate to the market rate, you'll notice that it'll sell for more than or less than the face value, depending on where the market rate is in comparison to the actual bond rate. So let's talk a little bit more about the definitions of bonds. Face amount. When you hear the word face amount, that is the face value. If the market rate equals the contract rate, then the bond will sell at that face value or that face amount. That's when market conditions equal the bond rate. Yeah. It's rare. It's very rare that actually happens. It's almost rare to the point where it doesn't exist, but it does once in a great while. If the market rate is greater than the contract rate, bond will sell for less than its face value. We call it a discount. We sell it at a discount. Again, you have an interest rate on your bond that is lower than the market rate. We'll sell it at a discount. The reason why they sell it at a discount is to get up to that market rate, right? That's why it's a discount. So the way to think about it is anytime the market rate is higher than the bond rate, we sell it at a discount. The opposite is also true. When the market rate is less than the contract rate, we sell it at a premium. Premium. So premium is when the bond rate is higher than the market rate, we sell it at a premium. When the market rate is higher than the bond rate, we sell it at a discount. So just try to remember that relationship. Price of a bond is quoted as a percentage of the bond's face value. Okay, so what does that mean? Here, let's look at this example. Let's say we have a $1,000 bond quoted at 98. Quoted at 98. When you see a quote and it says 98 or 109, that 98 is a percentage. It's 98%. Okay, so we quote bonds as a percentage of the face value. When it's quoted at 98% or 98, it's 98%. So $1,000 at 98 means we would purchase that bond for $980. Now, what does that tell us? If we purchase for $980 for a $1,000 bond, are we buying it at a discount or a premium? What do you think? Premium?
Yes.
So let's see. market rate is less than the contract rate.
1%.
Okay, so market rate less than the contract rate. Yes, we're buying that at a premium. That's right. Very good. And then the opposite would also be true. So if our bond for $1,000 was quoted at 109, that means they sold the bond to us for 1,090. That would be at a discount. Very good. Okay. So how do we account for bonds payable? When bonds are issued at less than or more than the face amount, the discount or premium must be amortized over the life of the bonds. At the maturity date, the face value must be repaid. So it's accounted for very similarly to the way that you would have accounted for a note or a standard note. The difference here is going to be with the interest or the discount. So here's an example. Let's assume that on January 1st, this company issued the following bond. $100,000 worth of bonds at a 12% contract interest rate to be paid semi-annual. The bond's term is 5 years, meaning the life of that bond is 5 years, and the market interest rate is also at 12%. In this situation, we see that the contract rate 12%, the market rate 12%. So we know there won't be a difference, right? So because there won't be a difference, there is no discount, there is no premium. The discount and premium only exists when there's a difference between the market rate and the rate of the bond.
Professor B,
Yes, Amy.
there's no an exact terminology of when there is no difference. It's just, is it a discounted premium and then it's just a balanced out? That's it?
Yeah, pretty much. So you might say that it is the I don't want to. How do I want to say this? Let me go back just a little bit. So, but yeah, there is no true difference. You just call it the face amount.
Okay.
Yeah, you just call it the face amount. So if there is no difference, there is no discount, there is no premium, we call it the face amount, which is basically saying there is no premium, there's no discount.
It's just, that's that total and that's it.
Exactly. Yep. So that only occurs when the market value equals the rate of the bond.
Okay.
Yep.
Thank you.
Yeah, absolutely. Good question. So to record this entry, we would debit our cash, 100,000, to increase to show the receipt of that bond, and we would increase our bonds payable by the same amount. Now, of course, it's the same amount. It's the face amount because the market rate equals the bond rate. Now, as we earlier said, the interest rate was 12%, which is also the market rate, and that's also the interest rate of the bond. And we said it was paid semi-annual. Now, here's how we calculate how much we're going to pay in interest. And we're going to pay, since we took the bond issuance date was January 1st, the first payment of interest to our bondholder is going to be at the end of June. And then we'll pay him again at the end of December. That's, remember, semi-annual. When you see semi-annual, that means we're paying interest twice a year. So on June 30th and on December 31, we're going to pay interest. But since this is only, so twice a year, we're going to pay $6,000 worth of interest. How do we get to $6,000? We took the face value of the bond, we multiply that by the 12%, we multiply the 12% by half. In other words, you could say, you could just divide the 12% by 2, which gives you 6%, times the 100,000, $6,000. How we got to the 6% is that because it's paid semi-annual, you take the annual rate and you divide that by 2, or divide by half, right? So we then, yeah, divide by 2, or multiply it by 0.5, which is the same as saying divide by 2. So you see that we would, we take the 12% is the annual rate. But since we pay semi-annually, we're paying that twice, so we take the annual rate and divide that by the number of payments, which in this case is 2. If it were something different, the easiest way to figure out what the interest rate is you take the annual rate, which is in this case 12%, you would divide that by 12. Okay, reason by 12, there's 12 months in the year. And then you would just figure out when it's paid. So if it's 12 months in a year, 12% divided by 12 is 1, times 6 months is 6. It's another way of doing it. So we got 100,000 times 6% is 6,000. We debit our interest expense to increase interest expense, and we credit our cash to decrease our cash to show the payment of the interest. Now, at the end of the 5 years, when the bond matures, we debit our bonds payable to decrease our bonds payable by 100,000, and we credit our cash to decrease our cash by 100,000. Now, you'll notice that the face value of the bond is only paid when the bond matures. That's the end of the bond, yeah? Here's another example. This one's at a discount. Okay, so let's say there's a discount involved. We have a $100,000 face value. The contract rate is 12%. The bond value is expected to has a useful life of 5 years. The market rate is 13%. So we know that there's a discount. The bond rate is 12%. The market rate is 13%. That means there's going to be a discount of 1%. So how do we get there? So when there's a discount, that means that we, the corporation, we're not going to receive the full amount. We're going to receive it at a discount. So the corporation will receive $96,406, not the full $100,000. The reason being is because there's a 1% discount. And that's because, as you know, the market rate was 13% and the bond rate was 12%, causing a difference, the 1% difference. So the calculation here, it shows that we have a debit to cash, increase our cash by $96,406. We debit our discount on bonds payable account by $3,594, and we credit the bonds payable, $100,000. Okay, so here's the breakdown. For the how do I want to put? We call this a carrying amount, which is the cash that we have received. So the bond payable is $96,406. How we got there? We took the face value, subtracted out the difference, which is that 1% discount, $3,594. So 100,000 minus the 3,594, that gives you 96,406. Of course, we have to make sure that our debits equal our credits, right? So we have this account called a discount on the bonds payable to represent that discount that we are receiving from the sale of the bond, $3,594. And of course, bonds payable, $100,000. Any questions on how that's accounted for, or does it make sense? Good. Okay. All right. I trust you.
Yes, Professor.
Okay. Thank you.
I think I get it.
You got it, Drew?
Yeah.
Okay. Sounds good. Okay. Now, we mentioned this word amortization a few times, and we've also discussed it a little bit in previous chapters. But let's talk about how do we amortize a bond discount. Every period, a portion of the bond discount must be reduced and added to the interest expense to reflect the passage of time. As you already know, we do that through this thing called adjusting entries. We learned a lot about that in previous chapters earlier on in the semester. This process of increasing our interest expense through amortization, or this process through increasing interest expense, we call that amortization. It's where we increase the contract rate of interest on the bond to the market rate of interest that existed at the date the bonds were issued. Ooh, that's a mouthful. Amortization is accounting for the passage of time and increasing interest expense. Let's talk a little bit more about that. How does it work? So, and this would be through the form of an adjusting entry. We debit our interest expense to increase interest expense, and we credit the discount on bonds payable. Okay. And of course it's made annually because it's an adjusting entry. Sometimes it will be, you could combine it with your semi-annual interest payment. But it's still basically an adjusting entry that you would, in that case, it would just be made twice. But in most cases, we would just make it as adjusting entry. But if you were to make the entry through the semi-annual interest payment, you would debit your interest expense, you would credit your discount, bonds payable, and credit your cash to represent the payment of that interest expense minus the discount. Okay. So very similar to what you learned about depreciation, there are a couple of methods to amortizing a bond discount. The first that we want to look at is the straight line method. It sounds just as it is, straight line. I mean, it's going to be the same amount for consecutive periods. And then of course there's the effective interest rate method, also known as just the interest rate method. Let's talk about both of those. The effective interest rate method is required by generally accepted accounting principles. However, the straight line method may also be used so the results do not differ significantly from the effective interest rate. When we utilize straight line method for amortization, we provide equal amounts of the discount or the premium to be written off to interest expense in each period. In other words, if I have a $100,000 bond and it's for 5 years, semi-annual, every single payment of interest, semi-annual, is going to be the same amount. That's the concept of straight line. It does not change over time. Straight line, right? That's the idea behind straight line. How does it look? Here we go. Here's a great example. We take the bond discount amount. The term of the bond is 5 years. That means if it's semi-annual, we take the amount divided by the 10 periods. Why 10 periods? Because it's semi-annual. It happens twice a year. It's 5 years. 5 times 2 means there's 10 periods. throughout the life of that bond. So we take the discount amount divided by the number of periods throughout the life of the bond. In this case, is 10 because it's semi-annual. 5 times 2 is 10. Take the discount amount divided by the 10 periods, gives us a semi-annual amortization of $359.40. Good so far?
Mhm.
Okay. All right. The combined entry to record this payment looks like this. We debit our interest expense, $6,359.40. We credit the discount on the bond payable, $359.40. And we credit cash, because obviously we got to pay all that, right? $6,000. This entry is made for each interest payment date because it's semi-annual, right? It remains the same over the life of the bond. Because remember, if it's straight line, that means it's going to be the same interest amount paid throughout the life of the bond. The effect of the discount amortization is to increase the interest expense on every semi-annual interest payment. In effect, it increases the contract rate of the interest and the interest rate approximate to the market rate. Okay, let's look at it from a premium perspective. We just saw it from a discount. Now let's look at it from a premium. Again, face amount, $100,000. The contract rate on the bond is 12%. It's 5 years in length. The market rate in this case is 11%. So now we're looking at it from a discount. From a premium. And remember, premium means that the contract rate on the bond is higher than the market rate. So premium. Okay, so we see a 1% difference. Now, how does it look? Because the contract rate is more than the market rate, the bond will sell more than its face value. Yes.
Subtraction. I'm just looking at it. Hello?
Yes, Drew.
Oh, I didn't know.
I'm sorry.
I'm just go on.
Drew, you good so far?
Yeah.
Okay. So before we looked at it from a discount rate, right? And when we looked at it from a discount, we received less cash because it's discount. We record the difference as a discount, and the face value still has to be repaid as bonds payable. But now it's at a premium, which means that our interest rate is higher than the market rate. Now we see that because of that, it's at a premium, we're going to receive more cash at a premium. We receive $103,769. And why is that? Because we're selling the bond at a premium, which means we're selling it at a 1% more than the market rate. And because of that, we record the face value of the bond, $100,000, and we record the premium on the bonds at $3,769. Now, how does that break out? We see the reason why it's $103,769 is because we take the $100,000 plus the premium amount. Good so far?
Yeah.
Okay. We'll get there. It's sometimes just the terminology that gets confusing.
Yeah.
Okay. So like bond discounts, the bond premium must be amortized over time, over the life of the bond, just like we did with the discount. Amortization of the bond Bond premium decreases the contract rate on the interest of the bond market rate that existed at the date the bond were issued. In other words, we're decreasing the amount to get back to that face value. So here's what the journal entries look like. We have a debit to premium of bonds payable, and we have a credit to interest expense. But you're saying, oh, Dr. B, that means we're decreasing interest expense. That's right, and the reason being is because when we have a bond premium, that means we are receiving more than the face value. When that happens, we need to adjust in order to get down to that face value. So the way to think about this is the ideal situation is that we have the face amount, which means that the market rate equals the rate of the bond. When there's a premium or if there's a discount, what needs to happen is that we need to get that back to the face amount. In other words, where the two are equal. So, in the event of a discount, we're reducing that discount amount to get to the face value. When there's a premium, we need to reduce the premium amount to get to the face value. That's why we make these adjusting entries. In the event that it's paid out through the semi-annual interest payment, we debit interest expense, debit the premium and bonds payable, and credit cash. So it's very, very similar to the way that the discount concept works. So how does it look? Through this example, we have a premium of bonds payable through $3,769. The life of the bond is 5 years. So we can pay out through semi-annual amortization $3,769 divided by the 10 periods. 10 periods because it's 5 years. Semi-annual means we do it twice per year. Gives you $376.90. So what does the journal entry look like? So as you know, we still pay out $6,000 semi-annual per year for a $100,000 bond for 5 years. We increase our interest expense by $5,623.10, and we increased our premium on bonds payable by $376.90 to get us to that $6,000. The reason why we have the debit to premium bonds payable is because it's a premium. If it were a discount, it would be the opposite would be true. It would be a discount on the cash side to the credit. The effective premium amortization is to decrease the interest expense on every semi-annual interest payment date, and of course, this effect is to get the contract rate to balance the market rate. Let's talk quickly about redemptions, and then we'll finish up the chapter. Corporations may redeem or call bonds as they mature. Remember, when you call something, you're redeeming it. You're calling it out of the market. When you put something, you're putting it back. We'll talk more about that again in the next chapter. But when you call something, that means you're redeeming it. You're taking it out. You are calling the bond. You're calling it to you. So a way of thinking about it. When you put, you're putting something back. It's often done when the market rate of interest declines below the contract rate. A callable bond can be redeemed by issuing when the company within the period of time is price stated at the bond indenture. Normally this happens at the time of maturity. Okay.
You showed this. I'm just saying that we've shown this before.
Yeah. Yep. So basically, this is to kind of reemphasize what happens when there's a callable bond in place, because what this shows is that when bonds are redeemed, these are the basically the terms that are used. So, and you've seen this before. I want to say it was like the past two chapters. You've seen these similar terms. The difference here is that we talked about it from a concept of depreciation, which is a little bit different. Because depreciation has to do with the depreciation of assets. With bonds, this is a way for companies to raise revenue, to raise funds to be used within the company. When the bond is redeemed or when it's paid back, we need to understand how that's recorded. So that word book value comes up again. As you know, book value is the difference. It's between the gain and the loss. So what does that look like? So when there's a gain, it's recorded as if the price was paid and redeemed below this bond carrying amount. When there's a loss, it's recorded as it's paid through redemption above the carrying amount. So again, when you're looking at your income statement, it's recorded as either a gain or a loss on the redemption of a bond. So how does that look? As we have the $100,000 face value.
Yes, that'll be 690.
You're almost there.
96,000.
That's right. Yes, yeah, that's right. So that's what it would look like if it were to be a discount. The face value would be 96,000. With a premium, it's the face value plus a premium payable.
Yeah.
But yeah, you're right. You're absolutely right when it comes to that. So it'd be 96,000 if it were a discount, 100,000 plus 4,000 if it were a premium. Let's look at this example. So let's assume that the corporation redeemed 1/4 of the bonds before the maturity date. Let's assume that. So as you know, when something gets redeemed before maturity, the company pays out a premium. So it's kind of like saying, hey, you gave me that loan. I'm going to pay you back early. So when I pay you back early, I'm going to give you a premium because I'm paying you back early. And so that's within the bond indenture that we talked about before. So the bonds payable is $25,000 because it's again 1/4 of 100,000. 1/4 of 100,000 is 25,000. Basically, all you're doing is taking 100,000 divided by 4. That's 1/4. It's 25,000. So $25,000 bonds payable. $1,000 gets allocated to premium on bonds payable, bringing it up to 26. Now, how we got to 26, you might be asking, or how did that $1,000 come about? Well, we took the because of the how do I want to say this? Because of the interest rate apportioned out, we took $4,000 times 25%, got us to $1,000. Another way to think about it, how do I want to put this? We took the premium of the bond payable, we multiplied that by 25%. Reason why by 25% is to represent 1/4 of that $4,000. Gets us to $1,000. So you got your bonds payable, which is the face amount. Face amount of 100,000 divided by 4 is 25,000. The premium on bonds payable is $1,000 because we took that $4,000 of bonds payable times 25%. Another way you could do it is you take your $4,000 divided by 4 to get the $1,000. Why divided by 4? Because it's 1/4. 25,000 bonds payable, 1,000 premium to the bond, premium on the bonds payable. The difference. Okay, so we pay out 24,000. The reason why we pay out 24,000 is because of the premium on the bonds payable. So it's basically saying 25,000 minus the premium. We pay out 24,000, and we allocate 2,000 to the gain on the redemption of bonds. I can already hear what you're saying, Dr. B. Those debits don't equal those credits, and that's a problem. Okay, you're right. They don't equal. So this is obviously 20. No, they do equal. What am I talking about? We paid out the 24,000 cash. I apologize. I misread that. We paid out the 24,000 in cash because we took our bonds payable minus the premium, 24,000. We recognize a gain on the redemption of bonds of 2,000. Now, how we got there? The difference on the carrying amount of the bond is redeemed. 26,000. We got there by taking the 25 plus the 1. The redemption of the price is 24,000, which is recorded as a gain. So we paid out the 24,000. The difference is 2,000, which is allocated to the gain of the redemption of the bonds. Good news is you don't have to worry too much about this on the exam. This is just it gets a little detailed, yeah.
Yeah, when is the exam?
The exam's at the end of the course, which is in 2 weeks. That's the final exam.
Just
Yep.
Just wondering.
You don't have to worry about it on that exam. You probably see it in the homework though, or the quiz.
Yes. I did see it.
Yep. Good question. So we assume that the corporation calls the remaining 75,000 outstanding, which is held by the private investor, 79,500 on July 1. Okay, so the reason why we paid 79,500 instead of the face value of 75,000 is because we gained a premium on the bonds payable and a loss on the redemption of bonds to get the 79,500. So let's talk about reporting on bonds payable. Bonds payable are reported as a liability on the balance sheet. Remember, anytime you see the word payable, it's a liability. The company owes that money to somebody else. So bonds payable is on the balance sheet as a liability. Any portion of that bond due within 1 year, as you know, is a current liability, and anything remaining over 1 year is called a long-term liability. So what do you think about it? If you have a bond that's 5 years, that first year or that first 12 months is the current portion of long-term debt. Current portion of long-term debt. And the current portion of the long-term debt is that first 12 months. 12 months, as you know, is current liability. Longer than 12 months, long-term liability. Any unamortized premium is reported in addition to the face value of bonds. Any discount reported as a reduction of the face value of the bonds. Description of the bond should also be reported on the financial statements and accompanying notes. Here's a nice example of what that looks like for any given company. You have your accounts payable, notes payable. The notes payable is the current portion of notes payable. Under current liabilities is the current portion of notes payable. This is also called the current portion of long-term debt. Salaries, payroll, interest payable, those are all current liabilities. Then your long-term liabilities, it'll spell it out. It'll say bonds payable. It'll usually give the interest rate and when it's due in 10 years. less unamortized discount gives you total notes payable, or plus any notes payable gives you total long-term liability, and then your total liability. So this is kind of like a breakdown of what it would look like on a balance sheet. Okay, last few slides. Here we go, at least for this chapter. Very important equation for you to know. Very important equation. Times interest earned. Times interest earned is used by analysts to assess the risk that bondholders will not receive interest payments. As you know, with any investment, there's risk. There's always a risk that you might not get paid back the loan that you issued. There's also risk that you might not get paid back the interest on that loan. So how do we compute that risk? We calculate this thing called times interest earned. We take the income before income tax, which, as you know, is found on the income statement, plus interest expense, also found on the income statement, divided by income expense, found on the income statement. That gives you your times interest earned. This ratio computes the number of times interest payments could be paid out of the current period earnings. Higher values of this ratio are considered favorable. Low values are considered unfavorable. Anything under 1 suggests that the company will be unable to cover interest payments from its current period before the taxes are due. So in other words, after you compute this ratio, if it's less than 1, not so good. You're not going to get paid your interest. Here's an example from Pepsi and Coca-Cola. So this is an interesting example. It shows the respective companies' interest expense and their income before income tax expressed. If you follow that calculation, you take your interest expense plus your interest before income tax divided by your income before income tax expense plus interest expense, gives you the ratio. As you can see, for all 4 of these companies, they are very favorable. They're above 1. So the chances are good that you'll receive your interest expense. This is just an example of how you would use that as the formula. Any questions on chapter 11? Everything that we covered so far. Good? Okay, I'm going to go ahead and stop this recording, and then I'll start the new recording for chapter 12.